Good evening, ladies and gentlemen. I'd like to welcome you all this evening to what is the third lecture in the Vice-Chancellor's public lecture series. Throughout the rest of this year, a number of leading ANU academics will deliver topical and engaging public lectures under the banner of the Vice-Chancellor's lecture series. These lectures are designed to share the talent we have at ANU with the ACT community and globally through the university's YouTube channel. I'm delighted that Professor Warwick McKibbin from the ANU College of Business and Economics is presenting tonight's lecture. In April this year, Professor McKibbin was named an ANU Public Policy Fellow in recognition of his significant contribution to public policy and public debate. Fellows have been selected on their contributions in areas as diverse as environment, health, finance and economics, defence, Indigenous affairs, population and international law. Among his many achievements, in 2005, Professor McKibbin formed the ANU Centre for Applied Macroeconomics Analysis and was the Centre's inaugural director. He also serves as a professorial fellow at the Lowy Institute for International Policy in Sydney and as a non-resident senior fellow at the Brookings Institute in Washington, DC, where he co-directs the climate change program. His work on economic solutions to address climate change has seen him play a prominent role in the media around the issues relating to Australia's carbon tax. This evening, Warwick will discuss the advantages and disadvantages of various emissions trading models and how we can design climate policy for a volatile world. Ladies and gentlemen, could you please join with me in welcoming Professor Warwick McKibbin.
Thank you very much, Vice-Chancellor. It's a great honour to be asked to give a lecture in the honour of the Vice-Chancellor. What I wanted to do, let me step back before I start. It's probably surprising that when I was asked to give this presentation, or a presentation, that I chose the issue of climate policy when I was asked probably 5 or 6 months ahead of time, because I work on a lot of different things, and the collapse of Europe or the global fiscal problems in the US were obviously interesting topics, but I figured that the perfect time to start debating this would be after July the 1st, when the government's carbon tax had come in, because people thought that would be the end of the debate. In fact, I've been working in this area since 1993, well, actually since 1991, but in 1993 I moved to Australia, and every time people think that we've come to the end of this debate, we discover that the policies we've designed or the issues we've addressed have been the wrong ones. And so this debate will not cease. So I thought this would be a good time because I thought there might be some debate in the community and in the wider policy world about how to design climate policy. The second reason for wanting to present this in this particular series is that I think it's incredibly important for academics to play a key role in this debate. There is a tendency, particularly in the area of climate policy design, for the political nature of the debate to dominate, and even for academics to become very political. I think it's important, and I regard the role of an academic is to be very precise on the best way to do things, to define the problem and to answer the question of how do we fix it, rather than to try and compromise and work out what political solution might get through a Congress or might get through a Parliament. It's very dangerous, I think, for academics to play politics. So what I thought I'd do is step back and try and make you think about what are the issues and how do we go about solving this problem, which I regard as one of the most critical facing the globe. Now, it's based on a lot of research, at least one book with my co-author Peter Wilcoxon, and probably 50 or 60 journal articles. The one which I think is getting a lot of attention in the international policy community is this paper we wrote for a book, which probably doesn't get me any credits in any quantitative ranking schemes, but it's a very, very important book on how you design global climate change policy by Aldi and Stavins. And in fact, I'll present some of the results from this work later on because I think quantitative evaluation is a key part of informing the debate. This is called Expecting the Unexpected Macroeconomic Volatility in Climate Policy, and hence the reason for my talk tonight. Now, there's two things that I do want to mention. One is that we have to be very careful how we design climate policy, and secondly, the world is highly volatile and incredibly unpredictable. And you've got to keep both of those things in mind as you're trying to design a solution. So what I want to do is firstly just get through the general conversation, just to get people to stand back from the popular press and the political debates and just think through some of the questions. So what do we need to do in a climate policy? What would happen, and again, if we're going to design policies for short-term adjustment, you've always got to keep an eye on where the long-term outcomes are intended to be. So it's a very good idea to understand where the world might be if they got it right. Because if the world did get it right, and I'm not that optimistic they will, but suppose they did, then if we're on a trajectory as a nation which is inconsistent with where the world will end up, it's going to be very expensive for us to then change direction and move to where the world will end up. So it's a useful thought experiment to ask the question, what would the future look like, in fact, if the entire world got their act together and we ended up with a very low-cost way of stabilising CO2 emissions? Another issue I want to stress, and I think people ignore this completely, and that is they focus on the climate policy and how it deals with the climate issue. But there's a real problem with unintended consequences, which we see all the time in the policy debates. And that is, suppose you have particular climate policies that can achieve exactly the same outcome for the environment. How do they change everything else in the system? And I'll talk about the two standard approaches, carbon trading and carbon taxes, and how they operate in transmitting shocks in the global economy. And hopefully will convince you that there is a very, very large difference between the two of those, and neither of them actually handles every particular shock that might and has come along, and the third way is actually possible. And I'll talk about that third way, which is called the McKibbin-Wilcoxon hybrid, which goes back to the mid-1990s in a Brookings publication. I want to talk about how we're dealing with this issue in Australia, talk about the Australian government approach. Rather than criticise it, which I will do, but there are some good features to this policy, and I'll talk about how I think we can actually make it better. I'll also talk about the opposition policy, because that is the alternative, and talk about how you can also make it better. And in fact, how I think you could actually merge the two and reach that elusive political consensus. But I always search for that, but I'm just an academic. So what is the climate policy issue? The climate policy issue comes down to managing the risk of climate change, given the cascading uncertainties. And the uncertainties are manifest throughout. They're dealing with how do we measure the future path of emissions, what will those future path of emissions be? Those emissions will drive concentrations, those concentrations will drive the climate. And there's a lot of uncertainty about how, when and where these impacts will occur. The climate itself will affect people, ecosystems and the economy. Again, a great deal of uncertainty. There's a lot of uncertainty about how policies will work and what the policy impact might be, how the policies might impact again on people, ecosystems and the economy. There's also enormous uncertainty about which countries will take action and when they will take action and what action will they take. And from the point of view of an Australian national interest, we should worry about this. If we believe in the fantasy that the whole world will reach an agreement, which we believed in Kyoto, we believed in Copenhagen, we believed at every subsequent meeting, that's not going to be the way the world will be. So the question is, how do we design our policy to be on the frontier of helping the world take action without locking ourselves into a suboptimal outcome? So what's an important hallmark? If you're going to design either a national carbon policy or a global carbon policy, the hallmark has to be longevity. This system has to last for many decades, not one electoral cycle, not 3 weeks. It has to last for many, many decades. And during the time of the existence of this policy, there will be very, very predictable changes occurring. We can predict demographic change reasonably well, although as you look into any of these areas, you see the uncertainties are actually greater than you think. And you can anticipate some of these things and you can build them into policy design. But there's going to be many unpredictable shocks. There'll be booms, there'll be recessions, there's going to be energy price shocks. We're going to get changes in political commitment here, overseas. We can't know when these will occur. We can't know how big they'll be in advance. So what we design has to deal with this uncertainty. Otherwise, if the climate policy collapses, then you have a serious problem with wasting decades before you reach another agreement. And again, to think about this in a world of uncertainty, I'm not asking a hypothetical question here, because we've seen very, very large changes, financial crises, emissions growth shocks in China. How big is some of this uncertainty? Well, this is a chart that I use quite often. It was from a paper by Wing-Tai Wu, who was just here for the China update, a well-known expert on China, and Peter Wilcoxon and myself. And what we did was we just looked at how well can we forecast the future. And this example is from that study, and there's two sets of lines here. The blue lines are the forecast from the Energy Information Administration made in 2002 for 2005 onwards. So at the bottom here we see these blue lines. The dotted line is the best guess of these extremely talented energy forecasters. The top line is the highest conceivable use of energy in China, and the bottom line is the lowest, most pessimistic view of the Chinese economy. And that gives you the range of high and low possible futures from 2005 onwards. We then went to the reports in 2007 and we said, well, let's see how well the forecasters did. So the yellow lines are the forecasts made in 2007, beginning at this point. This is from 2007, so the first point of the forecast is 2010. And what you can see, which is quite remarkable, is the error that was made 5 years into the future about the scale of energy use in China is orders of magnitude larger than the most optimistic or largest scenario that any of the forecasters could come up with. And what's interesting is that over this entire period, the uppermost bound doesn't cross the lower bound of the forecast in the future. So if this had been used, these forecasts had been used to tie China into the Kyoto Protocol with an emissions target, which is fairly proportional to energy use in a short period of time, China would have been blown away out of the Kyoto Protocol within 5 years of ratification, just as Canada has been blown out of the Kyoto Protocol. So the idea that you can do targets and timetables, given this incredible uncertainty, just shows how wrong the negotiators and the political processes that generated these sort of commitments have been. So what has been the standard approach? And that is, well, sit down, negotiate a target and a timetable under the UN Framework Convention on Climate Change. That is the Kyoto Protocol approach. After you reach the agreement, or in the process, go back to your economies, implement the targets either through carbon trading, through carbon taxes, through regulation, through subsidies, and then once you're doing that, because you know that the costs are going to be very different across countries, economists will tell you, well, you have to trade emissions, because if you can trade emission rights across countries, high-cost countries can buy permits from low-cost countries, and the costs across the world will be equalised, and the costs will be lower than otherwise. So that you tend to bring the economists in at the end to try and fix up the problem, but the problem is actually manifest in the design of the policy, because it doesn't deal with uncertainty. Now, there's some big flaws in targets and timetables. I've already pointed out the China experience. But really, to start with targets and timetables, you really need to know what the target should be, and there's not enough knowledge to calculate the exact global target from the science. Now, we have very good science, which gives us very good, I believe, good views on what concentration targets we should be aiming for. But in terms of the rate at which we achieve those targets, there's far less. And so what we should be, well, from the point of view of an economics contribution, is we should be focusing on balancing the risks from the climate change science against the expected costs of taking action. Now, some people will find that offensive. Some people will say there's no price too high to pay to save the planet. I would say, well, maybe that's correct, but that's what leads to the policies that we have, and that is no policies at all. Because as soon as a country pursues a policy which is too costly, the political process will unwind the policy. The second point I want to stress is, and this is actually not an ideological point, it's just that there is no scientific basis for what country targets should look like. There is scientific basis for the global target. There's no scientific basis for national targets. And again, if you did this efficiently, what you should do is do the cuts where it's cheapest to do to achieve the global target. So it's an economic question about who does the cuts, but who pays is a moral question. And those two questions should be kept separate from each other. So the usual approach of targets and timetables will never achieve an agreement. And my view is that at Copenhagen, that has been realised, and now we're moving away from targets and timetables to national actions. Now, let me pick on some economists. There's a theoretically elegant argument that you should use carbon trading across countries. Now, it is theoretically elegant argument, but actually the way to think about carbon permits is they're exactly like money. Carbon permits are something, it's an asset, it's printed by a government, and the value of that permit depends completely on the credibility of the government that prints them. So a carbon permit in Russia is very different to a carbon permit in Australia, is very different to a carbon permit in China. These carbon permits are not real things, they're claims over emissions which are up to a government to enforce. Now, we know that there's no global money. The reason there isn't global money is because governments have implicitly and explicitly absolutely different degrees of credibility. And I think it's naive and even dangerous, and some might even say a little stupid, to expect that the world's going to create a uniform global carbon market that's going to survive global shocks. And I only have to point to the euro to say, how much trouble have they had in Europe where the same sorts of countries with the same sorts of goals and philosophies can't actually create a single currency without enormous political and social disruption. If you put that on the global scale, you can see how vulnerable this type of model would be. So what's the reality of the policy design? And again, I go back to the Shergold review, which I regard as the best, by far, analysis from a government on what Australian policy should look like. And the Shergold review was based on the premise that the world was going to have a patchwork of national actions. And so the policy design should deal with the fact that the whole world is not going to reach an agreement before we start. And so the real question for policy is, how do you weave these patchwork arrangements in different countries under the UNFCCC process that'll enable the lowest cost action and early action at low cost by major emitters? So what you need nationally then, in my view, and this is the key to designing policy in Australia, and I'll use this as a benchmark to evaluating alternative policies, is you need a very clear long-term carbon price. And it's the long-term carbon price that drives innovation and investment. If you can understand that in 2030 the price of carbon will be $100 a tonne, you're more likely to invest and undertake R&D and bring to market different types of technologies than if your carbon price today is $100 a tonne, but you know with probability 1 it'll be 0 in 3 years. So the current carbon price really is not the driver, it's the future carbon price. And the question is, how do you create a futures carbon price? The second thing which is important is that there are some missing markets, and economists should be looking for missing markets because markets are very helpful. They're not a panacea, but if you've got a missing one and you can create it, it helps with the information dissemination across the economy. What's missing in this case is a market that enables corporations and individuals to make long-term decisions, risky decisions, but in a way that they can manage the risk of those decisions. So you want people to innovate. The whole solution to climate change will be innovation. But if we don't enable people to innovate because it's too risky, then there's definitely a gain from replacing what's a vacuum with a missing market. A third point is that while we're adjusting to the global system, we want to pick a policy that doesn't attempt to violate comparative advantage. We know that if you push against the comparative advantage of a country in any policy, it's going to be more costly than it needs to be. That's what comparative advantage is about. And the reality is that we have large endowments of low-cost fossil fuels in this economy. It doesn't mean we shouldn't do something. It means what we should do might be different to an economy that has no endowments of fossil fuels. And again, I'll stress the robustness question. Policy should be robust to the future. If your entire policy success, which is what the Kyoto Protocol was based on, is based on how well the Treasury can forecast in the Australian context or how well the US Treasury can forecast in the US context, you are taking an enormous risk that the future may turn out differently and your entire policy framework might collapse. Now, I would argue that it wasn't Treasury's fault that the carbon price in the world economy today is not $23 a tonne. The reality is the carbon price in the world is less than $10 a tonne. But that puts the choice of a carbon price that's in the legislation in the focus, and that's the real vulnerability of Australia's policy. So let's ask the question, what would the world look like if in fact we reached an agreement and we could pick the lowest cost global policy to hit a concentration target? Well, what you'd find is that only the fossil fuels that were left were those that were being used by low-cost, high-value output producers. So you would only burn fossil fuels where you got an enormously high rate of return and you did it very efficiently. Because if it was a price-based system, as the price of carbon rises, it'll knock out industries that aren't competitive. Now, given our endowments, and this is what shows up in the models uniformly, is that if nothing else changes, and this is taking technology as given and we can debate this, but if nothing else changes and our endowment is our endowment, Australia is the last place on earth where you would burn the last unit of carbon to generate energy. And so what you see, if you set a global carbon price, is industries migrating out of inefficient countries that burn carbon to efficient countries that burn carbon. And it is possible. You can show scenarios where Australia's carbon emissions actually go up in an efficient world, and other people's carbon emissions go to zero in an efficient world. Second point is, if you look at the world this way, that if you look forward and you don't change anything other than the carbon price, you're probably going to find the Australian energy system will be dominated by gas and coal, with a fairly big penetration of renewables, but it'll still remain largely a niche market. So for a uniform target in all countries, given the marginal abatement cost, that is how much does it cost to take a unit of carbon out of each economy, Australia would probably find it cheaper if we were given a target the same as everybody else. We would find it cheaper, instead of cutting our emissions, to pay another country to cut their emissions. And in fact, that's exactly what comes out of the Treasury modelling. And in fact, that's why the government policy has a restriction that only 50% of the abatement can be done by buying permits from overseas, because we know in many scenarios Australia would be buying almost all of their abatement offshore in an efficient world. Now, again, let me stress, where cuts are made should be an economic issue. Who pays is an ethical issue. There's nothing wrong with carbon trading across countries that we pay others to cut, but there are some technical issues on how you might actually do that. Now, I find in the political debate in every country where I operate and where I debate and do policy work, there's a confusion in the political process which is, I think, absolutely deliberate. People will say, we are cutting our emissions by X%, and they know that in fact they're not necessarily if they're going to trade carbon permits offshore. Now, the second thing I want to get to is a little bit more technical, but I think it's useful to see some numbers from some of these models, because I want to give you an example of how different carbon policy regimes can actually have a big impact on the world economy. In fact, could change the nature of the world economy in such a way that the regime itself destroys itself. And I think it's important to understand that. And this again is based on the paper that Pete Wilcoxon and Adele Morris and I wrote. So what we looked at in this paper, and I won't go through everything, but I just want to go through a few examples, is we look at two standard climate policies. One is what's called quantity-based. So you pick a target for emissions and you implement that target globally using cap and trade. That is, each country has a target. There's a target in the emission outcome that we want to achieve. We achieve that target, and countries buy and sell permits across borders. The second approach is a price-based approach. That is where all countries have a global carbon tax. So there's no need for carbon trading in that world, because if the price of carbon in America is the same as the price of carbon in Australia, there's no gains from trade. And so that's what the beauty of a carbon tax is, that you can actually get the equilibrium price without actually having large transfers across countries. So these are the two standard approaches. There are many, many other approaches, but they're the two that we look at. And then we look at two surprise shocks. Suppose that the developing world has the sort of growth spurt that I showed you in that chart that we have actually experienced in China. That is, they start growing roughly 3% more quickly per year for 20 years. So you design a system, you design the system so that the cap and trade and the carbon tax gives you exactly the same emission outcomes, exactly the same economic costs, and then you hit the system with a shock of a surprise growth in developing countries. The second surprise, which when we wrote this paper, we didn't think there would be a global financial crisis, but we figured there was likely to be. Suppose there's a global financial crisis. What happens to the world economy under these two systems? Now, you might think, oh, they'd be exactly the same. But actually, it's the complete opposite under the two policies. And so I'll just focus on what happens in the first 10 years. So again, the baseline here we're working with is a world in which we've already agreed to take action. So again, you can do this in a model, because we can do rational things in a model. People agree to take actions, and the carbon profile is emissions peak in 2028. They're 10% below 2002 by 2050 and 60% below by 2100. Now, at the time we wrote this, this was pretty much what the American Congress were discussing. The international community has actually moved to much deeper cuts. So don't be constrained by what the path of emission profiles look like in this case. And again, we look at these two differences. So the two shocks again is that a developing country boom, and the second one is an increase in our global financial crisis. In the graphs, the boom is called a growth shock, and the financial crisis is called a risk shock, because the way we model the financial crisis is by increasing global risk, so people start changing their behaviour. And that gives us four outcomes. Now, we're using a model which I won't go into. It is called the G-cube model of the world economy. there's a group at ANU who work with me, PhD students and colleagues, and also at the Brookings Institution in Washington, and there are colleagues at Treasury in Australia and other places that use this model. It's a complex model. You need a complex model because the world is a complex world, but it's very simple compared to the real world. And it's very comprehensive in the sense that it covers the entire world with a regional disaggregation, as you see on the slide, and there are 12 sectors of production, 5 of them are energy sectors. Now we've just completed a version of this where electric utilities have been disaggregated into all the alternative energy sources, but that's for another lecture. And then the shock that we're modelling is a massive boom in labour, not massive, it's the same as what we observed in China, but we get the same sort of take-off in India, in Latin America, in Africa, and we let this last for 15 years. Now, the one thing that we learn from the sort of economics that I do, that if one poor country becomes rich, the whole world is better off. Because as the countries become rich, they buy more from the rest of the world. This is purely an economic statement. I'm not talking about the environmental consequences just yet. But in terms of just GDP, that measure of economic activity, one country booming is good for everybody. Having China boom, developing a middle class, they buy stuff from the world makes more of it, people are better off. All regions eventually gain. Now, there's a timing issue which is kind of interesting. This is what we're showing you here is not all the regions in the model, but just the advanced regions, because this boom is happening off screen. This is the developing countries, they're having this boom that spills over to the industrial countries. These are major industrial countries. There's 3 time periods. The blue line is what happens initially, then the yellow line is what happens after 5 years, and the black line is what happens at year 10. Now, what's interesting is when this boom occurs, people realise that there's a lot of opportunities in these economies and capital starts moving from the industrial countries into the developing countries. That's what drags down the blue lines in many economies. They've got capital flowing out, and because it's flowing out, you've got less to produce within your own economy, and it goes into the developing countries. But if you trade a lot with the developing countries, like Japan trades a lot with China and East Asia where there's a boom, then your GDP goes up initially because the trade effect, which is positive, dominates the capital flow effect, which is negative. So what you see initially, and even in Australia, even though we trade a lot with Asia, we do get this small, less than 0.5% of GDP reduction relative to what it would have been. And it's important to remember this is all looking at the scenario relative to what the alternative was. So this is not a contraction of Australia of 0.25, it's Australian GDP would be 0.25 below what it would normally be, which is a different issue. So it's not a recession. But after a couple of years, as the wealth grows and as people in these countries become wealthier, they buy more from Australia, so Australia has to build our capital stock. And you can see that by the time you get 10 years out, Australia's doing very well out of this global boom. But this global capital allocation does actually give you this dynamic story, which actually most of the other models don't have because they don't have dynamics. Now that's the standard transmission process. And what you see in a price-based climate policy is where every country has started with the same price. They don't change their price because there's no cap on emissions. So what you find is in the developing world, emissions rise a lot. In the industrial world, emissions rise in some places a fair bit, some places not, depending on what they're producing, who they're trading with. But you can see clearly that GDP is positive, but you've actually violated your carbon constraint in this case. So you've allowed the boom to spill over and give you a better economic outcome, but you've missed your carbon target in the short run. Now, under a quantity-based target, the world is totally different. Under a quantity-based target, because China and India and the LDCs are in the agreement, they have less permits to sell and they want to buy more permits. So they drive up the price of permits quite substantially. Now, if you look at what that means in the GDP outcomes, take Australia, you can see instead of Australia gaining from a boom in developing countries, the nature of what we're producing and who we're trading with means that the trade effects, which were positive, are more than offset by the higher carbon price. Because we're carbon intensive, our activity drops. And you can see that the most carbon intensive, OPEC, for Eastern Europe and the former Soviet Union, largely Canada and the rest of the OECD, the US and Australia, we actually experience a contraction in economic activity as a result of a boom in the developing world. And why is that? It's because you've got the constraint like this, where because you have to accommodate more permits in the developing world, you have to have, in most cases, less permits in the industrial world. Now that's a fundamental change in economic transmission. So if we had a carbon trading system in place in 1997, a global trading system, and we had the boom in China that we're just going through now, we'd be talking about the deep recession in Australia rather than the boom that we're going through. I'm making a value judgment, I'm just saying it's fundamentally different. And the difference is not trivial. This is the difference between those two sets of results. So you can see if you have a carbon tax, Australia's GDP would be basically 0.5% higher than if you have a carbon trading system. So in summary then, you've got these two effects. The positive is the trade spillover offset by the negatives of a carbon price shock. Now let me just do a global financial crisis. Again, what we did here was we just said, let's suppose risk premiums around the world go up by 10%. What that does in this type of model is it causes people to stop spending, they stop investing, they're very uncertain about the future, so they stop doing all the activities which increase output. And we also do a housing shock in advanced countries because that was a big asymmetry. There was a lot of capital locked up in very inefficient investments in the US and Europe, which in fact the good news from the financial crisis is a lot of that capital was freed up from that wasted investment and is flowing to emerging economies and expanding their productive capacity. So we wanted to capture that effect as well. I won't go through the story of how it works. I just want to show you some results. So again, if we look at the risk shock, and this is the change in GDP relative to base, and you can see that this very simple, and we've done a lot more complex modelling of financial crises, but this stylised modelling shows that you do a pretty good job of blowing up the world because you've basically caused GDP to fall by between 4 and 5% in many economies. That's a deep recession. And you can see that this thing lasts for a very long time because once you stop investing, the time dimension of activity gets pushed well into the future. So that's what happens in a price-based climate policy. Now, what's interesting is if you look at the emissions actually go down as well. So with a price-based policy, you get quite a large emission reduction as well as a fairly significant economic slowdown. But if you have a carbon target, actually a carbon trading system acts like an automatic stabiliser because as the world goes into recession, the price of carbon goes down, and as the price of carbon goes down, you get the opposite effect to the previous story. You actually act to stimulate these economies because their input costs are going down at the same time as the demand is falling. So in this case, the quantity-based policy is a really good idea. So if we had a carbon trading system during the financial crisis, our carbon prices in Australia would have fallen, and that would have given us an additional stimulus. And you can see the difference between the quantity-based and the price-based is really the complete opposite now to what it was for the other shock. So I've given you two shocks which are not only realistic but have just happened, and you can see that these two types of policies are fundamentally different. And again, this is the emission outcome when you have a quantity-based target, and this has got everybody. So you can see that somebody's emissions has to go up because you've got this fixed target on emissions. You've constrained emissions from going up and from going down, and it turns out China does the best in this type of shock. There's a lot of capital moves to China because China doesn't have a housing collapse. China's got high productivity, so if you're pulling capital out of US houses, you're better off putting it into China, and so China absorbs most of the emission permits in the world. So again, both policies are very vulnerable to shocks, but in a different way. What we need then is the price-based approach when there's a global slowdown exacerbates that global slowdown because it keeps the marginal cost of emissions too high, whereas a quantity approach helps to stabilise the economy because it allows carbon prices to fall. But the key point here is neither of these policies dominate. What we need is from a design point of view, is something that when there's a boom, it acts like a tax at the margin, so we don't crowd out economic growth for our trading partners, or for trading partners of where the shock's occurring. And in a recession, it acts like a permit system. So that's a very hard thing to design, something that switches from one to the other, because both of these shocks are probably going to keep happening. Now this is where the McKibbin-Wilcoxon hybrid comes in, and I won't spend a lot of time on this because I'm going to run out of time, but the philosophy behind this is to have a deep cuts world, so announce deep cuts in every country. So I'm not saying it's a binding target and timetable, I'm saying it's what you need to create credibility to build markets, where you announce these deep cuts, but whether you hit that cut at any point in the future, the commitment is there unless it's too expensive, unless there's some threshold in which you cross, in which case you're allowed to have emissions above target for a period of time. And not only do you create these commitments, but you create assets, financial assets that are bound by this commitment. So you create annual emission permits, not just for this year, but for every single year for the next 100 years. So there'll be permits for 2050, there'll be permits for 2060. What you'll have is every year's permits in the future will be smaller than the year before. So by 2050, you only have half as many of these, and by 2100, you won't have any more left. And you create these permits, you give them away to households and firms. So you give half to households, half to industry. You can allocate them according to the Treasury calculations. In fact, these ratios sound very familiar with the government's policy, half compensation, although we don't want to overcompensate because that's a problem. But you actually get these assets into the market and into the balance sheets of households and firms so that they can make the decisions on how and where they're going to cut emissions. And you create a market to trade these. So the market that's traded is quite segmented. You can't use 2050 permits in 2040. You can only use them in the year in which they're valid. Secondly, you can't trade permits across countries. So there's no leakage. You can allow leakage, and we've talked about this. I won't talk about this now, though. And then the second thing you do is, this is the basic long-term market. This is what's driving the fundamentals. But then you announce a credible price collar. And what a price collar is, it's a cap on a price in a given year and a floor on a price in a given year. Sound familiar? Some of this is shown up in the government's policies. Except the government floor is above the world ceiling. So in a sense, the house is upside down, which is not a great foundation to build on. But beside that, the principles are right, but the implementation is not quite right. The second thing you do is you create a central bank of carbon, because what you want to do is control the short-term costs. Short-term costs are no good for anybody. Short-term volatility in a market is bad. Let the volatility be in the long-term market like we have in the long-term bond market, but let there be no volatility in the short-term market like we do with interest rates. So we hold the price of money fixed in most modern economies by having a central bank holding the interest rate, but we let a long-term price of money in the long-term bond market move up and down and allocate capital efficiently. So the long-term market is used here to explicitly drive emission reduction incentives, and the short-term market is used here to control the costs and increase the certainty for business. Now, what has the government done in Australia? Well, we've got a carbon tax of $23 per tonne, just came in last week, rising to around $26 per tonne in 2014-15. And then in the 30th of June, you've got one system. 1st of July 2015, you switch totally to a carbon trading system with a price ceiling of $20 above in the international price, which could only be the outcome of a political negotiation because it makes absolutely no sense. And a floor price of $15 a tonne, and these two margins rise together, the ceiling and the floor rise at 4% a year, and you're allowing imported permits, but because you know honestly deep down there's going to be an enormous number of them because the price of carbon in the rest of the world is going to be low, you have to stop it from coming in, so there's a cap of 50%. And then you don't really believe your policy is going to work, so you have to put in lots of subsidies and all sorts of distortions to try and make sure that you achieve not only the outcome you want, but also you satisfy all of the political constituencies who have vested interests in this debate. So what can go wrong? And again, I'm a big believer in robustness. So what I like to do when I design a policy is not say what is the best policy that we can have if the world works the way I think it does. It is how badly can this thing go wrong? Because that's really the test of the robustness of a policy. So what might happen? Well, suppose the world doesn't have an agreement. So carbon credits are not available. So it turns out we can't actually bring any carbon credits in. Then by definition, if we have a constraint in this country, the carbon price could be very high. And in fact, apparently it could be higher than $20 above the world ceiling. So in fact, it could turn out that we have almost no impact on emissions, but very high economic costs in Australia. So an alternative might be that the world has an agreement, but the price is less than $15 a tonne, which is at the moment, if we reached an agreement tomorrow, the prices probably would be less than $15 a tonne, because there's a global recession. And remember the scenario that I just presented. So what we'd have is a situation where there's a carbon price with certainty at roughly $26 per tonne, and then the next day drops to $15 a tonne. A lot of investments would be wiped out. This would be a complete devastation of a whole range of both fossil fuel reducing technologies and renewable technologies, and the government would have to come in and rescue not aluminium producers, but actually fossil fuel industry because of the investment collapse. Now, the third possibility is a really good news one, and that is, what if the world has an agreement and we have a global carbon market by 2015? So this is the ideal outcome. What we're seeing now and what we continue to see is the renewable energy targets, which are overlaying this, are driving up input costs and driving up energy. And we're going to be buying 50% of our emissions offshore. So the renewables are going to have real trouble penetrating into the market. And then we're going to have tens of billions of dollars of renewable energy funds wasted because this industry doesn't have a comparative advantage under many scenarios. It might work. It might work. I'm not saying you can't change your comparative advantage. It's pretty hard to do it within 2 years, however. So what's the outcome? The outcome of this whole policy is enormous uncertainty in the return to long-term investments in abatement activities. Why would you invest under this regime? It's much better to invest in lobbying activity rather than it is to change the way you do things. The second issue is the compensation issue. There are serious risks because the compensation has been given out not as emission permits, which is what I would give, because then the emission permits move with the price of carbon. It's given out as tax cuts and given out as dollar transfers and some permits, which means that all of a sudden you've taken the climate policy and turned it into an increased risk on your fiscal accounts because your revenue, particularly post-2015, is going to depend on the carbon price. And if suppose the world carbon price was $5, what you have to do is not only lose the revenue going from 28 to 15, which is about $3 to $4 billion, you then have to buy permits to keep the price off the floor, and therefore you've blown up your fiscal accounts. So rather than being, and the mistake that was made is the compensation was depending on the forecast carbon price, not the market price. So let me summarise my problem with the government policy. As you can tell, there are some good parts in that policy. Lots of it draw from the hybrid, but not in quite the right order. There's no long-term carbon price, there's no long-term carbon market, there's a lot of exclusions, so coverage is not complete and costs will be higher. You've increased uncertainty, created greater risk in the fiscal balance, and you don't have any bipartisan support. So the whole idea that this is a credible policy flies out the window. Now, what is the opposition policy? The opposition policy is the government effectively pays for emission reductions, plus you have subsidies to renewable energy. You're unlikely to reduce emissions at low cost because you're dealing purely with the generation of the energy, but a lot of our reductions will also come from people facing a higher cost of carbon and therefore changing their behaviour on the demand side. So by definition, the costs, if in a perfect comparison, the costs have to be higher under this policy. But I think this policy actually might work for small reductions. I just don't see how you can scale it up. So if you are going to really join in an international agreement, you're going to have to start this way and then switch. And that's the question is, what will that cost? So what's the problems with the opposition policy? No long-term carbon market, no long-term carbon price, exclusions, which means that the costs will be higher, increased uncertainty in the fiscal balance, and no bipartisan support. So I'd actually say both of these policies are not going to get us very far. However, you can actually move from where we are, I think, to a credible policy. Firstly, you've got to get rid of the idea that we're in the Kyoto world. And unfortunately, the Stern Review, the Garneau Review, all of those reviews have assumed the Kyoto world. That's not where we are. So therefore, the policies that might have been considered aren't the right policies. You've got to set long-term goals. This is a long-term issue. You've got to create a market. If you don't have a market, you're not going to get a futures price. If you don't have a futures price, it's going to be very hard. So we need these long-term permits and we need these long-term markets. I would argue that you cheap as much as the revenue in there in the private sector as you possibly can and let them choose how to spend the money to reduce emissions rather than churning it back into government. Because once it gets back in the hands of government, the politicians will then have the incentive to allocate the revenue for other purposes other than a carbon abatement purposes. It may be a good idea, but I think you find that most revenue that gets recycled tends to be wasted. I think you need an independent central bank of carbon to manage the short-term carbon price. You don't want to have carbon inputs from overseas, carbon permit imports, unless you have a very clear compliance mechanism. And you can design that, and there's some papers I've written on how you do that with Indonesia and other major trading partners. And again, once you get this right, you can drop the subsidies and other distortions. So what both parties have to realise is this is not about wedge politics, although that's what it's being used for. And it's also not about cutting emissions no matter what it costs. This is a very delicate exercise in cost and benefit. Again, climate policy is about risk management, and it's encouraging people to take risky activities, to undertake speculative ventures to try and reduce emissions at low cost. And in the end, if you don't have bipartisan agreement, you're not going to get very far. So in conclusion, when you look at it, the government policy actually looks a fair bit like McKibbin-Wilcoxon, and it started off actually in the Shergold report with lots of footnotes, but as we moved through time and the policy got debased, a lot of those footnotes disappeared. But I think you can actually take what we have and we can fix it pretty easily by creating these long-term permits. And actually, if you look at the opposition policy, and it's a bit hard to understand because I don't have the details yet, but it does have features of the McKibbin-Wilcoxon hybrid. And the key issue here is how do you pay for what they want to do and how do you make it more comprehensive? And I think if you brought a long-term market into their policy, you could actually achieve that. So my view in the end is that I'm an optimist, but you need a bipartisan policy, and I think there's a way of getting there once we get through the next election. And my website is both ANU and I have my own private website, sensiblepolicy.com. Happy to take questions.
Hi, I'm Professor Kieran Maher. I'm one of Warwick's colleagues in the Research School of Economics. Let me just open up for questions from the floor for
Take that
Warwick.
Thanks for your talk. Given the huge investment required in renewable technology, that's the only way we're really going to reduce emissions. Aren't subsidies necessary to actually create the investment in technology that's not yet commercially viable? And shouldn't we be focusing on getting those subsidies to commercial production?
So there definitely is a case for funding research and development. But if you don't have a carbon price, you won't be able to pull those technologies through to the market. I mean, that's the thing that's missing. Secondly, it's not clear that in Australia we're going to be the ones that do all the research and development, nor are we the ones that are going to generate the solar and the wind and we're certainly not going to generate the nuclear unless there's a change of attitude. But I think what you need is, what Australia's role here is actually not to think we're going to solve with 1.25% of global emissions the problem by just cutting our own emissions. What we need to do is demonstrate to the world that there are ways of doing this at very low cost in a very fossil fuel intensive economy and get a significant reduction in emissions so that when China and the US implement our policies, then we're going to get a much bigger global bang for the buck. So our role is a demonstration role. Now, if we pursue certain activities which are very much picking winners, we could have problems because we might discover that in Australia, subsidising hydro is not a really good idea because we don't have any water, and therefore other countries will say, well, let's not have hydro. But there is definitely an argument for R&D credits. There's definitely an argument for the investment side. But without the carbon price, I don't see how you pull it through to the market. Yep.
Hi, thanks for the lecture. I was just wondering if you could elaborate a bit more on the linking aspect of things, because it seems like you were saying in the beginning that linking things like currencies and markets is a really dangerous and risky thing. But you mentioned that there are ways that it could work.
So where I think there's the absolute critical linkage is investments by the industrial countries in helping developing countries both adapt and reduce their emissions. To think that you're going to get that sort of important linkage through trading carbon permits, I think is incredibly dangerous, because you have to, if we're going to accept a carbon permit in Australia from a project in India, we're going to have to be able to somehow go into India and say, well, is that project really reducing a unit of carbon in the world economy? My view of the CDM, the Clean Development Mechanism, is it's had a role, but it's shown us how not to do things. In fact, most of the CDM credits up until this point have been generated by hydro projects in China, hydroelectricity projects, which were already underway before the credits were allocated. So a fair bit of the reduction was already it's not additional. And so there's real problems, I think, in us interfering in developing countries in that way. I think we have to acknowledge that we have to have technology transfer, we have to have financial assistance, but let's design the carbon system country by country with a common price in it, and then do on top of that what's needed to get the international coalition together. Don't mix the two together because you've got too many targets and not enough instruments. The second issue on linkage is there's important linkages through carbon intensity and international trade. So again, yeah, if we just do a policy in one part of the world and we don't take into account the fact that there could be relocation of industry, then we've really got high cost, low return activities. So we have to do this in a way which prevents the leaking. And you can do that. So take the McKibbin-Wilcoxon hybrid. If we did that in Australia and we had a carbon price, which we've advocated for 15 years, of between $5 and $10 a tonne, you would get almost no leakage because the price is too low. But as the world moves forward and as we measure the world carbon price, we can move our price up in line with the world price, and the leakage effects are far less important, and therefore the politics of that is far less devastating to the policy.
You've done the analysis as if there's only two sort of major parties or options in Australia, whereas it looks like the Greens as a third party are playing quite a major role in driving whatever the policies are. And it also looks like it's recently occurred to Labor Party members that they might not have a long-term future as a party. So I'm wondering if you think it's perhaps important to be also mapping out faults, strengths of the Green Party policy positions, because they're quite a major impact in the process.
Well, I don't see any difference between the Green Party policy and the Labor Party policy as we currently see it. The reason for $28 a tonne or $23 a tonne has to be just the Greens. That was the price that we had to pay to get them in the coalition. Because again, and I'm not, apologies to anybody in the Green Party in the audience, but I think there's a view that prices don't work. And the whole purpose of a carbon tax is actually not to change people's behaviour, it's to close down coal mines and power stations. Because if you believe carbon prices work, you wouldn't start at $23 a tonne. That's a very high carbon price given the world price. So, I regard the Labor Party policy as being the Greens policy. And until I see a different policy coming out of the Labor Party, I'll continue to believe that.
Liz Bolton from the Fenner School. I was just wondering, when you're talking about a bipartisan, or even maybe it could be a tripartisan solution, just in a practical sense, how would you sort of see that coming into being and playing out and functioning? I wonder if you had any thoughts on that.
Well, again, if you can actually get someone to pre-commit to these long-term permits, and one of the arguments we make I gave an Academy of Social Sciences, we wrote a paper for a volume in 2005, where we looked at how you use economic design to change political outcomes. Now, if you can get these long-term permits allocated around the system, then all of a sudden, every Australian has long-term permits in their superannuation fund and in their portfolio. Every corporation has long-term permits on their balance sheet. And if you're clever, you've got many long-term permits on the balance sheet of the most fossil fuel intensive companies. So these things are now real assets because there's people who are willing to buy and sell these. Now, all of a sudden, the political pressure from the outside to the Conservative side would change, because if you're a fossil fuel intensive producer, you know the writing is kind of on the wall that you've got to change your behaviour. And you know if you destroy destroy the policy, you destroy the value on your balance sheet of that asset. And the beauty of these assets is that, in a portfolio sense, they're perfectly negatively correlated with the other coal fossil fuel assets. So if the world tightens the agreement, this long-term carbon permit market would instantaneously generate higher prices. So the balance sheet of this coal-fired power station or the fossil fuel intensive producer, the permit value would go up and the coal assets would go down. And so they've got a hedge, but they know they don't have much time, so they start to change their behaviour to free up some assets. And they finance their behaviour by selling these assets to other people who can't change their behaviour. Now, once that happens, the politics is totally different. Who's going to run, for example, on the policy of I'm going to abolish all real estate contracts in Australia and we'll start all over again? No one's going to vote for them unless you don't own any land. And fortunately, the majority of Australians have the assets. So that's, to me, how you incrementally do this, is change the pressure from the outside. And this is one way of doing it. Secondly, this pre-commitment, it ties not only the hands of the government, because no government's going to really deviate too much, but it also gives you a way to adapt if the world suddenly turns totally differently. So there's a lot of people who believe in tipping points. And if there's a tipping point, all of a sudden we're going to find, oh no, something's fundamentally shifted. We're seeing some major climate event. In this world, the futures market will instantaneously go through the roof and people will start moving immediately because they realise that their costs are going to go through the roof. In any other world, like a carbon tax world, first you've got to get everyone together to change the legislation, and then you have to get the whole world together to change the international agreement, and it's going to take you 3 or 4 decades or 3 or 4 years. Whereas under our system, I think you can process the information that we get from the climate much more quickly and much more meaningfully in terms of taking action.
Hi, thank you for your presentation. I was wanting to pull together some strands of the argument, in relation to the design features of what you present as an optimal scheme to manage risks for Australia and an optimal scheme for the world.
Yep.
Because in some respects, as you pointed out as well, there are circumstances that are specific to Australia in relation to, for example, our endowment in fossil fuels that makes any sort of climate policy have impacts on Australia specifically that are different to the rest of the world. So I'm wondering, what is the relationship that you see between the design features for the Australian scheme and for the global scheme? Because as well, you suggested that what Australia does could be seen as a kind of blueprint for the broader, the broader world model.
Okay, so again, there's more than three, but let me very simplify. There are three basic groups of countries. There are the high fossil fuel intensive industrial countries. There's the countries in the industrial world that don't have a lot of fossil fuels. Let's take Japan as one example. So these form coalitions politically. So you get Australia and Canada tend to behave the same way. The US is usually part of that. Then you've got the developing world, the emerging world, and there's lots of different characteristics in the emerging world. But firstly, what you need to do is to get the industrial countries to be taking binding action. So in our world where we have the carbon price band, you design the allocation of the long-term permits in an advanced economy to be a lot less than current emissions. So what that means is that the carbon price that you'd have in Australia would be the ceiling price, and in every industrial country you'd be up against the ceiling price. Now, what you do for developing countries and emerging economies is you give them a much bigger allocation than they currently need, which means that they'd be sitting on the floor price. Now, straight away, you've got differentiation. So straight away, you've got the ability to pay, and the contribution to the stock of existing emissions is taken into account in the allocation and the prices, the costs that these countries are paying. Now, as a developing country, say China, as it starts to grow and become wealthier, its constraint will eventually be binding, and it will move out from the floor to the ceiling, and it will become like an industrial country. Now, that's very simplistic. That's conceptually how you would do this, allowing for differentiation and allowing for these political issues that keep derailing negotiations. In practice, all countries are very, very different. So in practice, what will be done in say, China or India or Brazil will be very, very different based on, they've got different views of the world, they've got all sorts of different capacities. And so you have to tailor this sort of principle of price, trying to get a global price for the national conditions that actually exist. Now, I've spoken about this in Brazil in the late 90s, I've spoken about this in Japan, I've spoken about it in China, in India, and I've written extensively in India and in Indonesia. There are ways of doing this. In Indonesia, the way you would do this is you'd actually bring forestry into it pretty early, because they've got a problem with property rights on forestry, which is leading to massive land clearing. Now, if all of a sudden forestry became an asset because it was hooked into their national carbon trading scheme, that would address some of their forestry issues. But you don't want that to be plugged into a global scheme, because the French and others will block it. And that's what you find in the international negotiations. So you've got to keep the national schemes national and allow the national characteristics to come to bear on the broad principle, but deviate it. That to me is a much better way forward than the way that the UNFCCC is trying to do it at the moment. And all you need is one or two examples to make it show it's successful. And I think you'll start. And Australia had the opportunity, in my view. We really didn't matter in the global context. So, Australia's a good place to experiment. Get good policies working here. If we get it wrong, 99% of the world is okay. But if you get it right, then the whole world can be transformed.
We have time, I think, for one last question up the back.
Thank you for your talk. Professor McKibbin, under your model, is there any scope for superannuation funds to use their investors' money and funds, long-term savings into renewable technology, and therefore drive an investment in that sector? Because one of the debates the financial community is having now is how best they can use super funds for renewable technology and companies investing in Australia.
So, there's a big role for that, not just in renewables, but in infrastructure and a whole range of activities. But you don't want to force companies to do that. This should be a response to the rates of return that are expected in those industries. So if you have renewable energy at the moment has so much uncertainty about what the policy regime will be, even under the government. Once you start changing the floor price within 3 days of the policy coming in place, you're changing the expected rates of return. So why would you invest in these industries? So you want the channeling of all those investments to be an endogenous response to the framework that's been established. To force super funds to invest in renewables could be a total disaster. And think of the individual rights of the people whose funds are being invested. So I think it's a bit dangerous to do that sort of picking winners strategy. If you've got the right policy and you've got the right incentives, I think the industries will emerge however they emerge in the uncertain world in which we live. But the more impediments you have, the more regulatory approaches, the more blockages, the more lack of signals, market signals, the worse the allocation of capital will be. To me, is one of the big dangers that we're facing at the moment, is distorting too much what is potentially of enormous benefit to the world, but which could potentially then just blow up in our faces if we get it wrong.
Before inviting you all to join us for some refreshments and to continue this very interesting discussion outside, I'd just like to make a few concluding comments. It's a very exciting time and also a very worrying time to be an economist. Just in the last day, in discussions with my colleagues, we've talked about issues like climate change, global financial crises and sovereign debt default, other topics that Warwick's worked on, productivity slowdowns, and the risks of an ageing population and the problems of pensions and health insurance. What makes this a really great university, I feel, is that discussion doesn't just stay in the corridors of the economics department or of any of the other departments around this university. Those ideas flow out into the wider community through events like this, and there's a richness in the intellectual environment around this university that I missed very much when I was away. I was a student here, and when I came back a couple of years ago, it's very noticeable the richness of the environment here and the way that is a community, and I think that's part of Canberra as well. It's something that I really enjoy being a part of. I'd like to thank the Vice-Chancellor for supporting this series so that the ideas of so many of the great academics at this institution can be shared with the public, and I would like to in particular thank Warwick McKibbin for his very interesting talk tonight.
Thank you.